Hello, hi, good afternoon, everyone. So I hope everyone has refreshed yourself after the short break and ready for this burning question on for this panel discussion. In the meantime, please feel free to scan the QR on the slide and drop all the questions you have on the market, on any specific question you have. So we will try to address it as much as possible in our session today. So today we are tackling a big question. Is the current market environment is in a bubble state or is a breakout to another bull run cycle? So yeah, do feel free to send in your question. I think while we are waiting for a question from the Slido, we will get the ball running by asking Charmaine because she just presented on Singapore equity, right? So Charmaine, you mentioned about the multiple catalysts, right, for Singapore equities. One of it is on the EQTP that will expected to drive more flow into the small mid cap space. But we know Singapore equity or even STI is famous for stability because of the bank exposure. So how should investor position at this point in time? Should they still continue to host those big cap banks name, or they should have more into this small mid cap?
Okay, thank you so much for the question. So I think having bank exposure in a way provides you with that income resilience for your portfolio in terms of the dividend. As we all know by now, because all the banks are very committed to doing shareholders returns for their investors, right? So in terms of dividends, forward dividend yield for DBS, currently they are offering still 5% forward dividend yield as of the current share price. And for small mid cap space, there's actually many names and many pockets of opportunities as well. And one of the stock that we have always been advocating for since 2023 is actually UMS integration, and they actually just got listed on the FSMOne Malaysia last year, and I think it did pretty well on like year to date as well as year to date for the SGX market as well. So for UMS integration, it has always been a semiconductor play that we pick among all the other semiconductor name within the SGX market. And that's also because for the earnings potential as well as its matrix and relative valuation against like its peers like AEM as well as Franken. So yeah, so UMS integration is actually one of the key stock that we have always been advocating for. And this year actually we collaborated with SGX to feature a lot more small mid cap space. And this is also as part of the EQDP efforts to kind of revitalize the market and also help to cover more of these names. So we actually increase our coverage for all these small mid cap names. Do you want me to go through like some of it?
No worries. I think it's also important to highlight to our audience that when you're looking at the Singapore equities, right, it's not about banks, but they are also participating in this like semicon value chain, this AI overall trend. So I think the most importantly is strike a balance between the overall portfolio allocation, right?
Yeah, definitely.
Yeah, so we actually saw some burning question from the Slido. I think this is also related to the recent AI trend, the rally in the tech. So I would like to pose this question to Alwyn, right? So there's this question from Steven saying that recently Michael Burry actually shorted the hot semicon stocks like those Micron, Nvidia, while being bullish on those tech stock that has been beaten down like Microsoft. So we know this year itself, Mac 7 actually underperformed. So what is your opinion on this?
Michael Burry, yeah, he's one of the very famous investor in the universe. So, but just to let you know, right? Can anyone remember that Michael Burry actually called sell for Tesla in 2020, and then Tesla experienced a huge rally, and also a famous one is 2023. Michael Burry put out a very famous sell quote in his Twitter. And actually, market actually rallied very, very heavily since then. So I think the moral of the story is that as an analyst, as an fund manager, we tend to make good and bad calls. So although his recent few calls like the Nvidia as well as Palantir actually made until today is quite a good call, but just to let you know, as analysts, as fund managers, you tend to make good calls, bad calls at some time. But the really important thing is to look into the fundamentals. That's the most important part. As long as what you hold currently is fundamentally wrong, correct, the investment thesis is still there, then it's good to continue to hold. Like just now you mentioned like Micron. Micron is trading like what? Although it has experienced 200% year to date, just 6 months, 200% stock. But the company is, their forward PE is currently only 7 times. 7 times forward PE is one of the lowest in the big tech firms. So as long as the investment thesis remains strong, we continue to we continue to hold positively on such of these some of these companies, especially the Mac 7 firms. We are seeing potential turnaround because valuation is getting more and more cheaper. Like take an example, Microsoft also. Microsoft is now trading at close to 19 times PE after the recent rally. 19 times PE for one of the largest software firm in the world. So it's very cheap. Even if markets kind of like further correct in the next few months, if it falls to like 16, 15 times PE, that is still a very attractive buy. Do you think Microsoft will go bust in the next 1 year or so? Not really. So this is what we view currently. Yeah.
Yeah, I think there's also a follow-up question on what you said just now, Alwyn, because you mentioned about the software company, right? Because we know a few months ago, software actually had a sell-off because of the development in the AI. So do you think that software company will no longer be relevant with the development of AI and people should only focus more on hardware like semicon?
Yeah, so so why people are chasing now currently semicon is because their earnings potential, their earnings visibility is the greatest. Because companies, they spend capex, that capex are real money flowing into their earnings. But for software companies, what people are afraid is that AI will disrupt their businesses. If you ask me, I don't have an answer to you whether AI will disrupt or not, but we are seeing increasingly that companies are adopting AI, building more, building their own software. So definitely the risk is there. But if you ask me, is it something like suddenly you will change or suddenly these companies will go bust? No, their earnings for the next few years is still growing at close to 20% per annum. So there is still real earnings growth over there. But you are paid, but their valuation is like less than 20 times already. So to me now we see a valuation gap. As to, if you ask me 10 years later, which company will still survive, it's really a tough answer. But for the next 3 to 4 years, I believe that these companies will still be around. And what price you're paying now today is very attractive.
Yeah, I think definitely there are still value on this beaten down kind of software company. Just we need to be more selective on what is their development in this global AI trend. So I also gotten this question I would like to pose to Paul, because this audience think that today all our session and message is more on breakout to another bull run, but our title today is bubble or breakout, right? So as a portfolio manager, can you put yourself in the bubble camp? Like what are the risks you are monitoring, what you are doing to the portfolio in terms of risk management, so the audience can have an alternate view?
Yeah, so thanks. So I think just a brief overview is that past 2-3 years, FSMOne, we have been rightly very bullish on all the major markets that did very well. So imagine it's like I mentioned 2-3 years, right? So definitely now increasingly there's like good kind of pointers to support a breakout, and also there's good enough pointers to support a bubble kind of scenario, right? So it's very. So this kind of scenarios actually happens every year. It's just that what kind of intensities, right? Intensity, we talk about like share prices now and also valuation. So what I'm trying to say is that definitely the risk is higher, right? If anyone tell you the risk is lower, don't listen to them, right? So and the market is very big, right? And there are opportunities in outside of semicons, right? Why do we want to just focus on semicons and tech, right? Even within tech, Alwyn mentioned about software, Microsoft. Actually, increasingly, we also see much more value in terms of those software like the big tech giants. Earnings very strong, and it's like what is the risk of their sustainability in the future, right? So it's very attractive, right? Not just your semicons, your memory chips, or your designers. That's on tech. The other places is that breakout and bubble is like, I feel that we are mainly just focused on semicons. Why? The market is very big, right? You look at Hang Seng Tech, right? Hang Seng Tech actually in correction already, it's like down more than 30% since last year peak, right? So are they bad companies? They are not bad companies. Are they in breakout or bubble? They already like collapsed already and corrected, right? So there are a lot of values, right, everywhere. So the other part is even gold as well, right? I think that's the top selling volume in FSM1. I also put already, right, after the correction. So is it a bubble? It already corrected. So I think there are a lot of opportunities in the market, right? Don't just focus on one sector. Like us also, we actually diversify, right? Why do I want to be in just one sector, right? So right now, if I need to pick a side, right? If there's a gun on my head, as like pointing to me, as I pick one, right? I will choose Breakout, right? Because a lot of factors are supporting it. Even Michael Burry is supporting it because he's bearish, so I need to be bullish. Joke aside, I think he will be right at one point in time. He's always early, right? 6 months or 1 year early, right? So I don't know. So even he's just like further on, his bearish call is the instruments he bought is put options, right? It's only expired next year, right? Next year I think March and June. So there's still a long time. Like even you read deeply into what he buy, he's not saying next month or next 2 months or 3 months or 6 months, right? So why is he buying next year put, not this year, right? In another way, I think he also think it's bullish this year, right? Okay, thanks.
Yeah, I think all of you can feel a different vibe when you are listening to portfolio manager and analysts because they are from different kind of perspective.
Personally, I listen to Alwyn. We discuss a lot.
Yeah, just a follow-up question for you, Paul, right? Because you mentioned about gold. Yeah, for the first half of this year, gold is the gold fund is actually one of our top selling fund. But in terms of performance, right, it's actually the only negative within the top selling fund. So actually moving forward, what are the things you are seeing for gold, the catalyst that it will pick up or rebound?
Other than following FSMOne clients on FSMOne website as the top selling products, the other pointers that I look at is that goals, there are a lot of factors, right? It's not just war or whatsoever. I think the one key big things that you guys should focus on is central banks all over the world, they are actually restarting to buy. They've been buying for the past 2-3 years. And March, there was a dip. There was a kind of, I think Turkey or a few other central bankers that were selling because oil price actually spiked up. So for these kind of countries, they need working capital to support their country's operation. So when oil price spike up, they need to sell some assets to support it. So there was a temporary kind of selling by central banks in March. But then in April, May, and now, for past 3 months, you can see a spike from central bank buying. So I'm not saying, so I'm just sharing you the pointers. Why are some people like positive on it, right? So then on a more longer term basis, you do know that now I think, where do you want to keep your money, like US dollar, renminbi, or Sing dollar, or whatsoever? So everybody, if I ask like 10 people, you won't give me the same answer, right? That's because we are in an environment now that increasingly it's tough to pinpoint which currency is the safest, right? So in that environment, then people kind of fall back to the currency that have the longest track record, which is gold, right? It's like what, more than 5,000 years of track record. That's one thing. The other pointers, there are a lot of technical short-term and mid-term kind of perspective. Is that other pointer is if USD weaken, then it will support gold prices, right? And also some people will say that there's inflation hedge, those kind of other points. But the key thing is that the key points to support gold is your in terms of the central banks really buying into it. Then your the more theoretical part, the US dollar weakening. Yeah. But good job for keep on buying your gold price. Always like go on the FSMOne website. It's like top selling products.
Yeah, so I mean, just to add on to Paul, right? If you see why gold has been weakening in this past few months, other than the central bank thing, it's also the investment side. So if you say the demand from gold, right? Actually, the past few years, the for investment purpose actually grew quite a lot. In historically, investor buy gold through ETF, buy gold through gold bars. It's about 14% of the total gold demand. But last year, it spiked until 28%. So all these investors, a lot of them are actually shorter term investors. They are speculative. So you can see gold kind of experienced a huge volatility. And last year, because of the stronger, I mean this year because of stronger US dollar, a lot of these funds kind of flow out. So although I think that gold over the long term still has it's still a very attractive asset, but for us, we believe that gold should be part of. You should buy gold for the purpose of diversification instead of for speculation, because you can see gold can go up 5-6% a day, can drop 7-8% of a day. If something can drop so much a day, is it still considered a safe haven asset? Not really, right? So the entire idea is to for investors, gold should act as a portfolio diversifier because they have low correlation against the broader market. Yeah.
Yes, the other thing I'm quite excited is what my colleague is going to present later. It's a global income portfolio.
Yeah, I mean, back to gold, right? In terms of house view, we see it as a portfolio diversifier because it has low correlation with the traditional asset class. So let us scale down a bit the risk level. Go back to other asset class is about Singapore REITs. So just now, Charmaine, you didn't mention much about this segment. So our investor actually keen to know about our views on that. Maybe you can also link it to the central bank interest rate kind of outlook as REITs.
Okay, so wait, hold on. Okay, actually I did the slides for S-REITs, just that because of keeping mindful of the 30 minutes, I took that
time
out.
constraint, right?
Yeah, so S-REITs actually is a sector that is already very popular among investors. Yeah, it's always one of the most read article alongside the SG Bank's article. So S-REITs, actually early this year, we actually turned more positive on it. And then after that, the Middle East conflict happened. And then we have to return like not so confident on it again because it's a leverage sector after all. So this means that it's not that good during like higher for longer rate environment. So what I mean is that because S-REITs they take debt to fund all these assets, right? And MAS actually make sure that these S-REITs they don't take too much debt. So there's actually a limit as to how much debt they can take. So the leverage ratio for S-REITs is actually 50% maximum, like the ratio that they can take. Then interest coverage ratio must be a minimum of 1.5 times. It used to be 2.5 times. So now they changed to 1.5 times. Okay, so with interest rate going up, right, because of inflationary pressures, and that could impact S-REITs. So how so? Because if interest rates were to go up, some of the S-REITs that have near-term refinancing needs, for example, would definitely inflate their cost of debt. And then that will also compress down their interest coverage ratio. And then the other thing is that because all these property valuations matters when they calculate out the leverage ratio, right? If let's say interest rate were to go up, and then that could actually cause that potential cap rate expansion for these S-REITs, and that could also pressure the property valuations. And with that being said, this would means that mathematically, interest rate were to go up, and if let's say property valuation compresses on the back of that as well, their leverage ratio can actually go like hit the limit lah. And then what is going to happen is that MAS will step in and tell them to like come up with ways as to how they can lower it down. So some of the S-REIT will maybe like, in order to lower it down, they maybe have to do distress sale of their existing property. And another kind of thing that they can do is that they completely retire like the distribution policy for now, like suspend it, or they even need their sponsor to come and bail them out and like lend them a helpline. So we actually see this happen for some of one of the S-REIT actually, like the Manulife US office REIT. So the US office space, the US commercial real estate, as we all know by now, have been facing a lot of challenges because after COVID, people don't want to like go office anymore. People want to work from home. And then that has actually caused some of the demand to drop for some of the US offices. And there are actually 3 US office S-REIT on SGX. And because of that, these 3 US office S-REIT actually took proactive measures to actually tell investors that, hey, we are suspending the distribution policy for now because their leverage ratio obviously went up because the property valuation for this property actually fell, not because of like interest rates, not just because of interest rate increases, but also because the structural demand for these assets actually like come into question, you know, because if people are not occupying these assets, then the valuation kind of get impacted as well lah. So, and if this asset increasingly become more vacant, they also cannot receive much net property income, right? So that could also affect their ability to pay out distributions to shareholders. And because S-REITs is known for paying out distributions, so if let's say an S-REIT were to tell you that, oh, we are suspending our distribution policy for now, yeah, most investors would want to like, you know, escape. I mean, like, yeah, sell that S-REIT lah. So in this space, we are quite selective. So we only choose those S-REIT that are more have a much more robust balance sheet. So like what I hinted just now about the leverage ratio and interest coverage ratio, those are the two key measures that we look at. And the other thing that we look at is also the structural tailwinds that is backing these assets. So their properties need to be something that people still need. So maybe an example that I can come up with is like, for example, data centers. I think data centers is something that is growing and there's a lot of demand for it, and especially with the demand of AI continue to growing and the need for data centers to like continue growing as well. So data centers is definitely one of them, as well as actually grade A CBD assets within Singapore as well, because supply in Singapore is actually for the CBD is actually not growing as much. So the demand and everything is actually helping to with the valuation there, as well as the income potential over there. And also industrials as well.
Yeah, I think the key message is that investor would need to be mindful of the valuation and the balance sheet of the company when you come to investing into S-REITs. So there's another question from the ground about the tech sector as well. So I will post it to Alwyn. So this audience say that there are few Oracle debts is going to mature next year. So with increasing debt financing, do you see it as a breaking point? But I would like to actually bring this question to a broader kind of segment, because we know a lot of big tech companies actually starting to raise debt to fund their capex. So how do you see about this trend? Is this something that investors should be concerning?
I think the short answer is yes. It's something that we need to monitor very closely, because we believe that from starting today, second half of the year into 2027, you see increasing company getting finance their capex with debt through issuing bonds or through SPVs. You see more and more of this kind of activities. But just to mention that that's why we are more selective. Although you see Oracle, their cloud growth can be 80% per year over year, but we are seeing also, because they are very aggressive in raising their debt, their debt to EBITDA ratio is very high. It's the highest among any other hyperscalers. So and then you can see, I mean, to put it more technically, their credit spreads are also one of the highest among any other hyperscalers. So that means they faces the highest risk of defaulting. But I'm not saying they will default, but we generally think that their balance sheet is still able to support, but just that we are much more cautious. So within this, we are getting more selective. We like the big players, the hyperscalers, like your Alphabet, Microsoft, Amazon. These are very healthy players, although they have been raising debt, except for Microsoft. But you see their debt to EBITDA ratio is still at a very healthy level, and they have huge amount of cash. So this is able to finance them for the next following few quarters. This is also why the investors have been punished them. So their share prices, you see, like Microsoft, like Meta, has been falling quite heavily, because they're spending a lot. They're raising, some of them are raising debt, so which concerns investors. But what we see is somehow different. We see a potential valuation gap over there. First, just like I mentioned, PE ratios, valuations are very cheap. If you look at this space. Secondly, is that if you just take, I think just now Yong also got share, whereby if you take their cloud revenue every quarter divided by their the capex they spend, that means each dollar you spend, the revenue you get is more than the dollar you spend. So we are seeing a recovery in that space. That's why we want to still be positive on those big, good hyperscalers with good balance sheets, but we are more cautious on other players such as Oracle, such as SpaceX.
Yeah, I think the rising debt kind of environment, definitely something investors need to be mindful of. But Paul, I would like to ask you, right? Like, do you agree with what Alwyn has shared just now, and how it translates into the overall portfolio strategy for tech-related exposure?
I guess the question's already answered. We shouldn't be worried this year because it's next year, right? a lot of things to worry about. If you keep on thinking about next year, next 2 years, I've got so many things to worry. I need to know like next 3 months, 6 months.
Yeah, so okay, actually,
But in short, I'm worried about all those things that you guys worry about, right?
yeah, we actually have this question from the audience as well, because now with the development of AI, big data, all these things, right, investor can have easy access to all the information. So in this kind of era, what kind of value added can be provided by the portfolio manager? What kind of competitive advantage compared to, let's say, they are doing the allocation themselves?
The best thing is next session by my colleague, Global Income Portfolio. So I know you guys are very high risk, like you guys like, just keep on buying equities, but need to think about income as well, right? So I think at this moment, the new thing that we are launching is that the next session, yeah.
Yeah, so I believe audience will now really looking forward to our next session. Okay, so we have next question on Singapore as well, Charmaine. So this audience thinks that Singapore is actually a dependence on rule-based kind of a country, but current geopolitical situation actually contradict a rule-based kind of world. So how will this affect the investment in Singapore? Like how investors should position it for Singapore exposure in the overall portfolio, like affect like the impact from the geopolitical?
I think Singapore in terms is actually benefiting from this geopolitical tension in that sense. Even if we look at the tariffs, like the US tariffs on Singapore, right? Relatively, at least in the region, Singapore is actually benefiting. And another thing is that for I would like to see Singapore as the bridge between the East and the West as well. Because a lot of the US large tech companies are actually setting their Asia regional headquarters for Asia in Singapore. So this also means that they are increasingly seeing Singapore as a gateway towards targeting the Asia market. So on that note, I think Singapore is actually benefiting from this geopolitical tension, and we are also seeing that as to maybe like safe haven capital inflows as well. And I think in terms of trading data, they don't lie. So we can also see how foreign inflows as well as institutional capital inflows into Singapore that have been really growing. And if you guys are really interested to see in terms of the trading data, SGX actually report them every month. They actually put them on their website, and this is actually a number that we are also closely monitoring, because on a lot of investors' mind is always about whether this EQDP, is it just gonna be a short-term thing? Is it just gonna be like a short-term liquidity injection, and then after that, the market just die after that again? So it's definitely something that we are actively monitoring, and we also want to make sure that liquidity is really growing, and other tailwinds for the SGX market is also looking towards more upcoming IPOs. And also the upcoming SGX Nasdaq dual listing breach will also be another thing that will drive the further liquidity and also re-rating potential for Singapore market as well. So an example could be maybe an Asia-based growth company is seeking to list on SGX. They can actually submit a single set of documents and list on both SGX and Nasdaq with that dual listing breach. So this will also open up the opportunity for this company to be included in the STI in the future as well. Because if that company is in a high growth industry, the P multiple and things like that, and the earnings growth potential, market cap can also be something that translate that into its position into the STI. And overall, over time, this could also help to reposition the STI composition mix as well, away from like what you mentioned, like the banks and REITs heavy composition. Yeah, which is something that have always make it quite defensive in nature. But we have always been advocating that this year, what is driving the STI growth would be largely from industrials, and the banks would be the one to anchor the income resilience of STI. So that's why we are seeing capital gain from STI as well as income resilience. And with regards to comparing with other markets, other developed markets, because of its less tech-heavy exposure, this could also channel it to be a less volatile play. And that's why in recent semiconductor sell-off, or even as global bond yield spike, right? Singapore was actually one of the few markets that actually closed in the green for that day. And so in terms of portfolio, I would suggest probably have Singapore alongside your growth oriented place. So for example, like your tech, your AI, I think Singapore will complement that because of its less volatile nature. Paul, do you have something to add?
Yeah, the next thing that we are going to present is that there's Singapore inside.
Right. So make sure we are really able to satisfy our audience for our next session. So yeah, a follow-up question to you, Charmaine, because you mentioned from the geopolitical tension environment, Singapore actually benefited from it because of the fund flow. So this audience actually want to know, what if the war ended? So will the flow actually reverse out from Singapore?
That's a very good question as well. But I think what is keeping things within Singapore, another thing is also its currency. I think many the currency strength of Singapore is actually also increasing. Reason being because Singapore actually don't use interest rate as its primary monetary tool. It actually uses its forex. So in order to combat the imported inflation with the surging oil prices, right? Singapore is actually looking to steepen its SGD. And with that being said, with the SGD being more stable and stronger, more investors would be more keen to probably hold their assets in SG as well. And I think that's also one of the main reason why the banks are seeing a lot of like that inflows coming in, like the capital inflows. And I don't think it's also just coming from Dubai as well. I think it's also coming from mainland China also. Yeah, some of it. So that would help.
Yeah, thanks, Charmaine. So we have gotten a lot of interesting questions from the ground. So please keep them coming by scanning the QR to post your question. So next one, I would like to hear it from Alwyn, right? Because for this AI trend, data center, we actually consume a lot of power and energy. So is it something that worth for investor to actually look into and position into in terms of like renewable or energy related exposure?
Yeah, so talking about the entire data center chain, right? So currently, I think the data center sector is facing a huge bottleneck, although companies spending more and more on building their data center. But data center has its own issue, whereby first is the power. So a lot of it, because when it comes to like US, there are grid connections. All of them are very, very old, more than 40 years, very old. So a lot of companies find it hard to get new electricity or new power to power their data center. So what they do, is that they are increasingly shift their reliance onto those on-site power generation. That means it's like they buy a machine which is such as the gas turbine to put it next to their data center, and they put it next to their data center to provide energy to their data center. So this has benefited a lot of all these companies doing this. Like one of the companies like GE Vernova. GE Vernova is a company that built the gas turbine, so natural gas turbine. So currently we have seen it's a very old kind of industrial company, but now they have seen new chances. And you see, for this example, the GE Vernova, the order backlog now is about 4-point-something times. That means their order are enough to cover 4 years of their revenue. And we are seeing increasing of this demand. And secondly is the nuclear, because now they are getting all those nuclear, they want to rely on more on nuclear because it's clean and it's, but the downside is you need at least 10 years to build. So now a lot of trades is onto the small, medium nuclear reaction. These are small nuclear reaction that put next to your data centers. It's like about, it takes about only 3 to 5 years to build. So a lot of people has also been buying into this kind of stock names. And also some of it is the grid companies, the companies that do the power grids, that helps you to optimize your power control when it comes to data center. All those companies are also doing quite well. So these are the opportunities that we are seeing across the data center value chain. Yeah.
Yeah, so I think we have been listening a lot from our panelists and also earlier session in terms of different kind of country or sectors kind of exposure. So would like to get Paul also to share more about what is the latest our portfolio positioning for our managed portfolio, which part of the sector or country that we overweight or underweight at this point in time?
Actually, like you guys, we also been riding the wave since early this year. So it's the same wave. What is the wave like? The things that we like a lot Japan, Asia Semicon, Global Semicon. Recently also, we've been adding into Hang Seng Tech. I think nobody talk about Hang Seng Tech now. So I wait for everyone talk about it when it's like 30% higher. Then probably I'll take profit. But those are the things that, so we have a mixture. So not just like those that is in current momentum, but things that actually very cheap, like quite attractive, and have good fundamentals. So don't forget about those things that actually not riding the wave now, right? So you need to have a balance in terms of your portfolio. I think this year, the other thing that we did, Alwyn got a very right call. It's like he downgraded healthcare early part of this year, which actually went nowhere. So it helped our portfolio as well. So our portfolios actually gained from other positioning. So yeah, Japan, overweight Asia, yeah, overweight tech, right? Those are the things.
I think one of the value offered by our portfolio manager is also to find a hidden gem in the market, buy into the segment that maybe some of the retail investor not there to buy in when it's low and it's cheap. So we have gotten another question on Singapore equity as well. So we know Singapore equity has been performing very well. Like if you look at STI, right, for the past 1 year, it's close to 30%. So it's not that normal for a market that used to be boring and kind of sideways kind of thing. So is it a good time for investor to take profit, or are you expecting some healthy correction in the near term?
My target for STI is 6,000 by 2028. So definitely there's still some upside. And alongside that upside, that potential upside, you are also getting rewarded with dividends. So I think if you see on the total total return perspective, right, your dividends plus your capital gain, I think it's still quite attractive of a market, given that it's relatively less volatile compared to like all those more stronger tech-heavy economies like your South Korea and Taiwan, for example. So definitely at current valuation, I think STI is something that investors can still buy. But also another part of the market that's not being captured by the STI is the small mid-cap sector. So currently in Singapore, a lot of EQDP funds have actually been launched, and a lot of funding would actually be deployed to all these small mid-cap stocks. And actually, if you look at the FTSE Singapore Small Mid Cap Index, it actually performed better than the STI. So even more than 30%, for example. So that could be an area that investors can look at. And also, in terms of first half of this year, we have also see that for it, within a small mid cap space, where are all these institutional flows going in? As what I mentioned earlier just now, it's actually going into tech and industrials names. So we have seen quite robust rally for AEM, like what I shared. It actually went up more than 500% in the first half of this year and corrected a bit slightly recently. So now it's about up year to date, maybe 460%, I think. Yeah, so we also see like UMS. That's also another company that I think I say quite a few times already, is listed on the Busan. And year to date, actually, it did quite well. And also, so the small mid cap space, EQDP funds are able to tap into that. But I don't think it's available to Malaysia investors as of now. But in future, I believe that there is going to be upcoming ETFs that is going to track this space that's coming up, that can allow investors to actually tap on this space more easily. And so that's why I think for Singapore exposure, maybe not just look at the large cap, which is your STI, also consider maybe the small mid cap space, or even consider some of the UTs, like the unit trusts that actually have exposure to this small mid cap space.
Yeah, I think it all boils down to what are the exposure that investor want to choose and how they allocate across their overall investment portfolio. So yeah, due to the time constraint, right, I will taking this last question from the ground. It's a follow-up question for you, Alvyn, when you talk about the energy and electricity. So I think it's from the same audience. So the audience is saying that if electricity is really the bottleneck, so why we are not seeing the same trend in energy stocks like what we are seeing in the memory because of the shortage? So do you have any insight on this?
Okay, so the main issue, the main difference is that one, electricity is for everybody. It's for consumer use. So government will cap how much money they're gonna make. So that's the thing. Chips are not. Chips are for the big players. So definitely these players have higher pricing power. You know, like for companies like Samsung Electronics, SK Hynix, Micron, they are making a lot of money from this DRAM chips. DRAM chips like let's say quarter over quarter, you know how much is their prices growing? 100%. And this is why we are seeing for the memory chips companies, right? Their investment thesis is what? Their pricing power. They have very strong pricing power, and because of that, it's a massive undersupply. So for like electricity, it's a different story. Government will make sure that some of the electricity is enough for every consumer use at a reasonable price. So you cannot charge too high. So they will only allocate they only have some allocation to data centers given that they have enough electricity for all of the citizens, all of the consumers. So this is the major differences.
Yeah, I think this is a very important point. It might be some of the things that investor might miss out, the government policy. So this is something that we might need to take into consideration when you are making your investment decision. So with that, we will end our panel discussion session today. So thank you for our panelists. I hope everyone have gotten some insight from this session. And please stay tuned for our next session for a very interesting global income portfolio as previewed by Paul. Thank you very much.